Warren Ingram, Executive Director at Galileo. Capitalist messing with you, Warren Ingram. That's a much better signal on a cell phone this evening. Talk to me about Regulation 28, its origins and purpose, if you would.
So it's actually been with us in one form or another since the 1960s. And it's regulations that are designed to protect investors who put their money into retirement funds and trying to ensure that they get a spread of assets in their portfolios, so that they don't just, for example, have all their money sitting in shares and then the stock market collapses and they lose 30 or 40% of their money, and potentially it's their retirement life savings. So, one of the fundamentals of all investments is, diversification is a great way to manage risk. And so instead of just leaving that to very honest, very trustworthy fund managers and just telling them, look, folks, off you go and make sure these portfolios are diversified, there were regulations that were put in place to say these are exactly the limits that you can invest in when you're investing in shares or in property or in hedge funds and the like. And so rather than allowing fund managers full discretion as to what they can and can't do, the regulations are put in place to say, well, at least if you really believe in shares, that's fine, but you can't have 100% of a retirement fund in shares. You're allowed 75% as an example. So it's quite an old set of regulations. It's been updated quite regularly over the years. And in my view, the logic is good. I don't think there's really a big problem in terms of having a good spread of assets. That principle applies to all money, I think. But sometimes it needs to be updated a bit. For example, with how much South Africans can invest of their retirement funds in the country and how much can be invested out of the country. I think that's probably, to me, the main talking point around adjusting Regulation 28 now.
This is another form of exchange control. And, we've had exchange controls in South Africa ever since the Nats roamed the earth, because South Africans were smart and wanted to get their money out the country because they could see South Africa going to hell in a handbasket as we went into civil war. It was terribly destructive political period in South Africa. And the Nats went near. And so you couldn't take any money out, and then you could only take little bits out. And then since democracy, we have seen a relaxation of exchange controls, except in pension funds. Why are we not allowed to say, I would like to have a lot more of my money in American companies, European companies, Chinese companies, if I want to?
And I think it's one of those things where especially for retirees who possibly are close to actually, or sorry, not retirees, but people who are close to retirement. So let's say you're retiring at 65 and you're 1 year away, and if people then say, well, hang on, I'm really worried about South Africa, and they send all their money out at let's say at 16 rand or 17 rand to the dollar. And things change, the cycle turns, emerging markets go back into favor, and we see the rand back at let's say 11 to the dollar, and we see the JSE performing extremely well. The people with their retirement funds will be needing to earn their rands and spend their rands, and suddenly they've got a lot less rands. And I know in this environment that sounds like a really crazy scenario to sketch, but this has happened quite a few times in the past where the rand blows out and then comes back. And with retirement money, if you need to fund someone's lifestyle expenses in South Africa, you want to manage that currency exposure so that they don't get hit by a massive swing one way or the other. So I think there's some logic to controlling the offshore allocation. My sense is that it's a bit low. At the moment, a retirement fund can put 25% of its assets overseas and an additional 5% into Africa. So they get to a 30% exposure. And to me, that's probably the one that they need to look at to say, well, the JSE is getting smaller in terms of the number of quality shares that investors can own in a retirement fund. And I think that poses a whole new level of risks to retirees. And therefore, to reduce that risk, we need to allow a greater overseas exposure. And I think if someone were to ask me, and I'm sure they won't, from Treasury, my view is that it probably needs to go to a 50-50 split between local and overseas assets.
Why force people, though, to invest in a particular jurisdiction? if in the scenario that you paint, suddenly the currency turns, well, I made a choice. It is my money, my retirement money. Is it because government gives me a tax break? I mean, that gives them, I suppose, the authority and the power then to dictate how I spend my money. If you're going to be accepting my tax break to put money into a retirement fund, well, then you have to play by my rules. And these are the rules that I set because I am government and I make the rules and you shall obey.
I think there's possibly an element of that, but it's also just about trying to manage investor behavior. Unfortunately, if we have to look at the history of stock markets and the history of the way investors have behaved in different times in markets, unfortunately, investors don't necessarily act in their own best interests when they make their investment decisions. They often tend to allow emotion to cloud their decisions in the short term, and then tend to be a little bit too quick to make a change, often at the worst possible moment. So I think that there is an element of control and a commanded control to this, which does chase. But at the same time, I think there is good intent in terms of saying, if we can try and protect people from the worst of their own behavior, hopefully we end up with a better set of decisions. And I really do think, this diversification of assets is a really important argument, and it's a really important thing that should be drilled into investment decisions. But the geography discussion is probably one that's a bit slower to evolve. So certainly, when the rand was a lot more stable and interest rates were really high here, the temptation to send a lot of money out was quite small because you got a really good reward either from the stock market or the bond market in South Africa for your retirement money, especially because retirement funds don't pay income tax. So whatever growth you've got from bonds inside your retirement fund, let's say not long ago it was 11 or 12% a year. That was tax-free growth inside the retirement fund. There was a good argument for that. I think what's happened, thanks to the Zuma years, is that the rand's really gone on a long structural decline. And that's been really damaging. But I think it might be a mistake to forecast that as an inevitable future. And I think that's maybe where the regulators have been a bit slow to adapt. But no question, they do set the rules, they do give us the tax breaks, and hopefully they start to listen to opening the Regulation 28 up a bit more, and not just for infrastructure projects, but also for international investments.
And this is the discussion at the moment. I mean, the discussion is, and there's a real fear right now amongst people who have pensions, because there's a lot of speculation as to what government is going to do to raise the money it needs to plug the gap in the budget. And one of those things that it could do, and it is under discussion, is to use pension funds. And you don't force pension funds necessarily to do your bidding, but you make life very difficult for pension funds that don't act patriotically or don't look at the great example, the great opportunities you present to them. And you could be forced to take a percentage of your pension fund and pop it into Eskom or into SAA or into anything equally horrendous.
I think the fear element is real, and I'm not sure that it's necessarily warranted. I think, if we were sitting under the Zuma era government, I would be a lot more worried. I think the current dispensation, and certainly the thinking has evolved a lot more from there. So my sense of this is that it's a case of actually opening up the gap for retirement funds to invest in infrastructure projects that they deem to be bankable, and I think that's an important criteria in this whole thing. So it's not a case of saying to retirement funds, you must all, giving them sort of really subtle pressure or potentially regulatory pressure. It's a case of saying, if we say, we can make it more explicit in retirement funds rules, especially with Regulation 28, where potentially retirement funds are allowed to go, let's say, to a maximum of 30% of the fund in unlisted bankable infrastructure projects. Then what happens is retirement funds still need to go and do their due diligence, make sure that they're comfortable with the risk-reward of relationship of making that decision, and then hopefully getting a good return. And I always think, some of the best infrastructure projects in South Africa have delivered a great return for investors. Just think about the toll road from Johannesburg to Maputo. That's an infrastructure project that was done as a public-private partnership. And if someone had offered me that opportunity, a decade ago and said, you can get capital growth on this, and you're going to get a guaranteed, monthly income from a toll road. Pre-COVID, a toll road was a pretty certain, way of getting money. And for retirement funds, that's what they're looking for, is, pretty bankable projects where investors can get consistent returns in a relatively low risk way. And I think that's the logic of amending Regulation 28 to make it wider. It would be really scary, really counterproductive if they amended Regulation 28 to force pension funds to invest, for example, directly in Eskom with a blank check, or Transnet, or any other of those projects. I think it needs to be a case of saying you are allowed to invest more money, but you make the decision, and what we'll do is create the environment that these projects are bankable. If that's how Treasury approaches it, I'm really excited. I think the good pension fund managers are always looking for those kinds of projects to manage risk and maybe move away from stock market volatility, because a toll road is really a wonderful thing to own, or to own a share of. If you've got sheer traffic, and you can imagine a toll road between Joburg and Durban on an Easter weekend.
And the conversation also changes about the merits of toll roads when you're getting an income from a road that you're driving on. And it's sort of counterintuitive, but it's kind of, you're driving on this road that is actually, giving you a pension one day. You're getting a stake in the future, which makes the ultimate sense. I mean, so there's a lot of fear and misinformation, because I'm not too sure that National Treasury is moving nearly quickly enough on reforms to Regulation 28. Our appeal, I suppose, tonight, please speed it up so that we can get rid of the disinformation and there's so many people who are deliberately manipulating the uncertainty right now for their own ends, to encourage aggressive, pure offshore investment, for example. And it may be the right thing to do. I don't know the answer, but it's certainly, in a world where we've got few options, more options are better than what we have right now.
I agree. I think the range of options should expand. I do think we should still have some safety nets built in, and trustworthy safety nets, and that would work brilliantly. And then I agree with your point wholeheartedly about a lot of the fearmongers out there that are just pushing their own agenda, because they can't create this environment of fear about South Africa and telling people to cash in retirement funds, and send all your money overseas. And that will end in tears. I'm not saying don't have a portion of your money overseas. Of course you should, and retirement funds should have a greater portion. But balance is always important in these. And the South African government bonds and potentially one day good infrastructure projects will be a great revenue generator for people who live here and need to spend the money that's generated from their retirement funds.
Thank you, Warren Ingram, Personal Financial Advisor, Executive Director at Galileo Capital.